Hi everyone, it's Marissa here from Rise High, and today I'm coming to you with some important changes that have happened in the last week that I think it's important for you to be aware of. So last week was a big week in the space of lending and banks. We had the Reserve Bank meeting and they kept the rate very low at 0.1% as they have, and they have also come out and said that rates will continue to stay low for the foreseeable future for at least the next 12 months. But another big thing that happened last week was that APRA, which is the regulatory body that regulates and supervises the banks of Australia, they actually came out and decided to interfere with the housing market. And what they did was they've actually issued a requirement for banks to increase their assessment rates to have a buffer of 3% above the actual interest rate that you're paying on your loan. So I'm going to explain to you what this means for you and what you can do about it. So just to have some background news. Firstly, what it actually means is currently when you apply for a loan, the bank actually assesses your ability to repay the loan at the, not actually at the actual rate that you're paying, they assess it at an assessment rate, which at the moment has to be at least 2.5% higher than your actual interest rate. Moving forward, starting from the 1st of November, banks must apply an assessment rate which is at least 3% higher than the interest rate that you're actually going to pay on that loan. What does this mean? This means that basically it is going to reduce your borrowing capacity because you're going to have to demonstrate to the bank that you can afford to repay the loan at a higher interest rate, even though the actual interest rate hasn't increased. So why has APRA done this? Well, APRA's basically done this to take some heat off the property market and to protect borrowers against the inevitable long-term situation where interest rates will ultimately increase. Remember, we are in an environment now where interest rates are historical lows, and we do need to prepare for the fact that interest rates will increase in the future. But when you come to the guts of what this actually means for you, it does mean that your borrowing capacity will reduce. And it's been estimated that your borrowing capacity will reduce by about 5%. So for every 100,000 that you're currently able to borrow, as of 1st of November, you'll only potentially be able to borrow 95,000. Okay? This may cause issues if you're looking to buy a property in the future, or it may cause issues if you're looking to refinance your loans. For example, if you recently got a loan or you've had a loan and you'd like to refinance it, just because you could afford it in the past and just because we could get bank approval for it in the past doesn't necessarily mean we're going to be able to get that approval moving forward at the same loan amount, even if your circumstances are exactly the same, simply because of this change to the assessment rate lifting up. So what can you do about this? Firstly, I'm going to give you 6 tips on what you can do to maintain your borrowing capacity, potentially even increase your borrowing capacity. Tip number 1 is look at your living expenses. So one thing that banks are really looking at now is they want to see your living expenses in the 3 to 6 months prior to you applying for the loan application. And specifically, they're looking at how you spend your money and where you spend your money. If you're able to manage and reduce your living expenses, then that is going to that's actually going to make a great contribution to maintaining and increasing your borrowing capacity. Also, a word of caution to avoid things like afterpay and payday lenders so that you can maximise the savings that you're making on your living expenses. Secondly, eliminate expensive debt. So these are things like your credit cards, your personal loans, car loans, anything that has a higher interest rate than your home loan. These are the sorts of things that we want to try and eliminate if we don't need. Reduce the limits on credit cards if we don't need the full limits, or potentially look at consolidating them into a cheaper debt like a home loan. This is going to go a long way into making up that gap that you're going to see happen when the assessment rates change. The other thing that you can do, tip number 3, is you can look to extend the term of your loan where it makes sense. So for example, if you've got a home loan and an investment loan, and you might want to, your priority might be to pay down your home loan first, you might want to talk to us about extending the term of your investment loan. That will actually reduce your repayments on that investment loan and will enable you to have more cash available to put towards your home loan, but at the same time it will actually increase your borrowing capacity for any future borrowings. So that's also another good strategy that we can implement to increase your borrowing capacity once it drops. Tip number 4 is to avoid interest-only terms if you're trying to maximize your borrowing capacity. So the reason why this one is important is that if you do apply for a loan and you get an interest-only period, let's say for example the first 5 years are interest-only, it does mean that the whole loan has to be repaid over a 25-year term, which is the term remaining, rather than a 30-year term. This is ultimately going to increase your repayments, and as a result, it reduces your borrowing capacity. So if you're able to eliminate those interest-only terms or reduce those interest-only terms, it actually, whilst the repayment's a little bit higher because you are paying a principal and interest repayment, it actually works to increase your borrowing capacity and gives you the ability to borrow more money and have that higher borrowing capacity. Tip number 5 is save more money. So this is about having a higher deposit. This is especially important if you're looking to buy a home, your first home, or looking to upgrade. If you have a higher deposit, it means your loan to value ratio is lower. So it means you're borrowing less money against the value of the house. And lower loan to value ratios will also possibly result in lower interest rates. And the lower the interest rate, the lower your assessment rate, which is going to be good news for your borrowing capacity. Finally, tip number 6, find and use a good mortgage broker, especially one from the team at Rise High. It's super important to work with a good mortgage broker who has a best interest duty towards you, to always put your best interest first, and who has access to lots of lenders who can actually assess which lender is going to be best suited to you to maximise your borrowing capacity. Hope this has been useful to you. We're here to answer all of your questions. We're here to support you through this. These changes take effect as at the end of October, starting 1st of November. So make sure you get in with your questions. If you have any questions between now and then, you can contact our team anytime. Thanks and have a great day. Bye.